In just the last 2 years, companies have poured over $10 trillion into artificial intelligence. We've seen Nvidia's stock price rocket from $150 to over $900. Microsoft alone has sunk more than $60 billion into the AI race. Everyone, from tech giants to tiny startups, is betting the farm on AI. But there's a huge problem hiding in plain sight. The math just doesn't add up. Companies are spending hundreds of billions of dollars, and so far, they're making almost nothing back. This isn't just a bubble. It's looking like the dot-com crash 2.0, but on a scale that could dwarf it completely. Let's break down the staggering numbers. First, let's look at the spending. The infrastructure costs alone are mind-boggling. In 2023, about $200 billion was spent. That's projected to hit $350 billion in 2024 and over $400 billion in 2025. We're talking about nearly $1 trillion in just 3 years on the foundational hardware. The big 5 tech companies have collectively spent around $300 billion in the last 2 years alone. Microsoft is leading the charge with over $60 billion, which includes their famous $13 billion investment in OpenAI. Google isn't far behind, spending $50 billion. Meta has thrown $40 billion at the wall, and Amazon has committed $30 billion. All this spending has turned Nvidia into a kingmaker. Their revenue exploded from $15 billion in 2022 to $47 billion in 2023, and it's on track to surpass $100 billion in 2024. Why? Because everyone needs their H100 and H200 chips, which cost anywhere from $25,000 to $40,000 apiece. Building a single large-scale AI cluster can cost between $500 million and $1 billion. The spending is absolutely astronomical. But what about the other side of the equation? What about the revenue? This is where the whole story starts to unravel. Let's start with the poster child, OpenAI. They're projected to have about $3.5 billion in revenue, but their costs are over $5 billion. That's a $2 billion loss. Yet the company is valued at an insane $150 billion. That's 43 times their revenue for a company that is hemorrhaging cash. Let's look at the big players. Microsoft is hoping to generate 10 to 15 billion in new AI revenue, but remember they spent 60 billion. At this rate, it would take them 4 to 6 years just to break even on their investment, and that's assuming their revenue estimates are accurate and costs don't increase. Google is in a similar boat. They've spent 50 billion to generate maybe 15 to 20 billion in AI revenue. And what's their brilliant strategy to compete? They're giving away their flagship product, Gemini, for free. They are literally giving away a product that cost them billions to develop. Meta has spent 40 billion. And what do they have to show for it? A few new features with minimal revenue, most of which are also free. Amazon's AI efforts are projected to bring in 10 to 15 billion, but they've spent 30 billion. Meanwhile, their most famous AI product, Alexa, loses billions of dollars every single year. The fundamental math is horrifying. The tech giants have spent a combined $300 billion to generate maybe 10 to 15 billion in new attributable revenue. That's a spending-to-revenue ratio of about 20 to 1. They need 20 years just to get their money back, without even considering interest or the ever-increasing costs. This is not a sustainable business model. Part of the problem is that the use cases, while cool, aren't generating the kind of money everyone expected. Take ChatGPT. It has about 10 million paying subscribers at $20 a month. That sounds great, right? That's $2.4 billion a year. But it's not enough to cover their massive compute costs, which is why they still lose billions. Microsoft's Copilot has fewer than 5 million users, generating about 1.8 billion a year. Again, a drop in the ocean compared to the investment. What's worse, the growth has plateaued. The number of new sign-ups is roughly equal to the number of people canceling their subscriptions. The addressable market is turning out to be much smaller than the hype suggested. What about the enterprise market? Surely businesses are seeing transformational gains. Well, an MIT study found that AI improves productivity by about 26%. That's good. It's a solid improvement. But is it transformational? Does a 26% boost justify spending hundreds of billions of dollars on new infrastructure and software licenses? For most companies, the answer is a resounding no. Then there's the cost crisis, which is spiraling out of control. Just training the GPT-4 model is estimated to have cost over $100 million in compute power. But the real killer is inference, the cost of running the model to answer your queries. Each query costs between 1 and 4 cents. If you have 10 billion queries a month, that's $1.2 to $5 billion a year just to keep the lights on. The deadly trap here is that the models aren't getting cheaper to run. They're getting bigger, more complex, and more expensive. And we haven't even talked about the energy crisis. Training GPT-4 consumed about 50 gigawatt hours of electricity. That's enough to power 5,000 homes for an entire year. A single data center cluster with 10,000 chips can continuously draw 7 megawatts of power. A large AI facility can consume 35 to 70 megawatts, which translates to an electricity and cooling bill of $75 to $150 million a year. One report projects that by 2027, AI data centers could consume more electricity than the entire country of Argentina. This is environmentally and economically unsustainable. All of this brings us to the bubble. Look at Nvidia. Its stock is up 6 times in 2 years, reaching a market cap of $3 trillion. Its price-to-earnings ratio is 65. For context, a PE ratio over 50 is widely considered bubble territory. The stock is priced for absolute perfection. Any hint of a slowdown, any sign that this astronomical growth can't continue forever, and the stock will crash. This is the dot-com bubble all over again. Between 1999 and 2000, internet stocks exploded on hype. Then the Nasdaq crashed by 78%. $3 trillion of value vanished. The companies that survived, like Amazon and Google, were the ones that actually had revenue and a path to profitability. The companies that died were the ones that had a great story, tons of hype, but no way to make money. The parallels to 2024 AI are undeniable. We have a real, powerful technology, but it's attached to impossible valuations and, for most, a complete lack of revenue. The costs are just too high, and the markets aren't big enough. So what will trigger the crash? It could be a number of things. A major AI startup could fail spectacularly, burning through billions of dollars before shutting down. The revenue growth could completely stall, with products like ChatGPT and Copilot hitting a hard ceiling. Or most likely, companies will finally look at their balance sheets and realize the costs are unsustainable. They'll cut spending, which creates a doom loop for companies like Nvidia, whose entire valuation is based on that spending. Here is my prediction. Nvidia is facing a 50 to 70% decline. A drop from $900 a share back down to $300. That would wipe out $2 trillion in market value. The big tech giants will see a 20 to 40% decline as they are forced to write off tens of billions in failed AI investments. And as for the AI startups, 90% of them will fail. The only ones left standing will be those with real products and real revenue. Here's a potential timeline. In 2025, we'll see spending start to slow, and the big tech stocks will begin to decline. In 2026, the big revenue misses will come, and Nvidia could be down 40 to 50%. By 2027, the bubble will have officially popped, leading to mass failures and consolidation. From 2028 to 2029, the market will stabilize, and the true long-term survivors will emerge. We could see $10 trillion in investment evaporate, leaving only $2 trillion in actual sustainable value. That's $8 trillion vanished into thin air. In the end, AI will become what the internet and the cloud are today, essential, boring infrastructure. Its valuation will reflect its utility, not its hype. So why does this matter to you? If you own Nvidia stock above $700, you are carrying significant risk. The big tech stocks like Microsoft, Google, and Amazon are safer, but a 20 to 40% decline is very realistic. And if you're invested in AI startups, know that you're facing a 90% risk of failure. Now is the time to consider de-risking. Take some profits off the table, diversify your portfolio, and wait for the post-crash opportunities that are sure to come. This isn't financial advice, it's just pattern recognition. The technology works, but the expectations are impossible. And when expectations meet reality, reality always wins. Thanks for watching. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into the tech economy. See you next time.